Welcome everybody to All Things Macro, episode number 6. This is being recorded on April 14th, 2026 at 7:30 p.m. Today we had a good day in the stock market. S&P is up 1.2%, Nasdaq up 1.8%. Oil almost flattened a little bit. It's trading below 100 at $95 per barrel. The CPI index is at 3.4%, and core CPI is sitting at 3.8%. I also wanted to talk and cover month to date indexes a little bit because there has been a good rebound. S&P is up 6.5%, Nasdaq up 4%. Um, what market is pricing in here? So go ahead, Eric.
Yeah, it's a little bit hard to tell. So quick recap from last week. We were talking about there's going to be a ceasefire, the markets are rebounding. Fast forward 1 week later, that still hasn't really come to fruition with regards to the ceasefire, and the U.S. is kind of they're still they're still yeah, they're still working on agreements, but the market seems to be looking through all this. And one interesting point that I saw today is we talk about the 10-year yield on the treasury bonds, and that's actually been going down. It was rising up towards 4.5%, which we talked about being a pretty key level for markets and for inflation, because that flows through higher mortgage rates, which are priced off of the 10-year yield. But it's been kind of coming back down to around 4%. And in relation to the equity markets moving up the past couple weeks, I think overall the markets are looking through what's going on in the Middle East, and what Trump keeps changing, day to day, week to week. I think they've definitely gotten tired of what's going on, and they're just saying we're going to look at company earnings, and we're just going to stick to fundamentals here. So yeah, so overall, I think year to date we're pretty close to even on the S&P. Nasdaq, I don't remember exact numbers, but I think it's also pretty similar. So it's kind of weird to think about that we're almost back at all-time highs again.
So what is market seeing that everyone else is missing? Because if we think about everything that's going on in terms of the P stocks, I didn't hear anything that is super positive in terms of the discussions. There's no agreement. I would imagine the Strait of Hormuz is still tense now. US is blocking some of the ports in Iran, and today I see that some of the containers were directed back to some of the ports of Iran, saying that they cannot go through a certain area. And I know there is also this whole tension about all the mines uh, that are in place, and also Iran is still not letting the vessels go through the Strait of Hormuz. So there is that there is that uncertainty. And also I hear that some of the LNG facilities in Qatar are heavily damaged. Usually it takes up to 2 to 3 years to actually build the infrastructure, and all the fertilizers are uh, still jammed because of the blockage there. So is it correct to assume that the market doesn't care as much about the energy as it did before? I'm just trying to understand a little bit. Dave, I don't know if you have any hypothesis as to. I know S&P indices and US economy just has 1% impact in the energy segment overall. So maybe that's not a huge factor, but so far we saw continuous declines, and all of a sudden we are seeing this huge rebound. I'm hearing that the numbers are getting back to where they were in February, which means that it's almost it's almost completely rebounded since the war has begun. So yeah,
Yeah, I
yeah.
I think there's a few things. One is that the market tends to panic. There's a saying that it takes the stairs up and the elevator down.
Mhm.
That's because nobody wants to take a big bath and lose, get cut in half or something like that. So the market will panic and you'll see these kind of quick drops. But then when if it doesn't drop or people change their minds or it levels off, people get kind of bored. But everybody kind of comes back in the pool, right? So I think that anytime you hear of a major war, it's going to make the stock market jittery. But as people get more used to it and forget about it, sadly, life kind of goes on. And the U.S. is a major oil producer now. There are other oil producers. We're seeing oil go up, obviously, to highs, but it's I don't even think it's at all time highs. It was higher. I think maybe 20 years ago it was higher, something like that, per barrel of oil.
Mhm.
So you know it, it will adjust. It will absorb the conflict. That is just the nature of the market. That's the nature of humans. Um, One nice thing about for better or worse, American investors is I feel like we have a short memory. So, you know, the Great Recession was a massive, much larger event, and within 4 years we were at all-time highs again. So, it's short-lived. Yeah.
So you think we are past the worst days and everything going forward, at least this
Well,
year is looking brighter.
I
Just
wouldn't.
this year. I'm
I
not
wouldn't.
saying I'm not
No.
saying the
What
yeah,
I would say is that the Strait of Hormuz is blocked and has been blocked. So
yeah.
people have absorbed that. It could always get worse. I'm not saying it can't get worse. People can make the news worse. And by make the news, I mean bad things will happen and people will get scared again. We've seen that a lot in the Trump presidency in general. Something happens, people panic, then markets kind of wrestle with it and adjust.
Right. Yeah. So Dave, just wanted to know a little bit about how the CPI and PPI numbers are looking. Just for our viewers to give an idea about what CPI is. It's essentially consumer price index, essentially how much strain it would have on your wallet as you go to any grocery store and buy some regular stuff. PPI is more purchaser price index, which is how much the companies, the firms that produce these goods and services are paying for some of the services and the raw material that they need to procure. So right now the PPI is sitting at 2% and the CPI is at 3.3%. Essentially, the consumer is paying more than what the businesses are paying. So this means that it's a strain more on consumers than the businesses. So yeah, Eric, I will let you give us an update if there is any on some of these numbers that trickled in the last week.
Yeah, I believe it was earlier today we got an updated PPI number for March, which showed if you analyze the month over month change, it's 4%,
Hmm.
4% annualized increase for producers. So
Yeah.
I think there was a more recent shift in it looks like the goods sector. I haven't been able to dig in to see exactly the reason for that. Because uh I'm not sure if they calculate PPI exactly the same way they calculate CPI, but it's supposed to essentially flow through into CPI. But what we've seen in the past few months is, inflation was coming down pretty consistently the past year. And then once we got into January, that's when we saw, a lot of like exogenous can never say the word, but exogenous shocks. So something that comes from outside of the model, like Venezuela happened, and then Iran happened, and things that just really threw a wrench into the inflationary story. So
Ongoing tariff
tariffs, yeah, which
changes,
I had
uh,
forgotten tariffs.
thrash, basically.
Yeah.
Yeah,
Uh,
yeah.
So for our viewers, I will let either one of you answer this. For our viewers, help us understand why it is important to be looking at these numbers and how the role, the prominence of these numbers at a macro level, holistically?
Well, I'm gonna say a couple things. First that CPI and PPI, and the other one is CPE, right? Or is the basically inflation, what you know, how far your money goes. The higher it is, the more expensive things are. And I think all of us now are more in line with inflation in general, since we talk about the price of eggs constantly now. So, you know, those numbers are basically inflation and how we measure inflation. Consumer price index is just an average of a weighted average of prices and their increase. Generally, prices go up. There's a lot of reasons for that. I won't get too into it, but it's a good thing, actually. Inflation at a small level is a good thing. You want some inflation all the time. And I'm going to pivot a little bit to talk about recessions because
Already,
we talk about, oh,
already getting into
because
the topic already.
we talk about,
Let,
you don't want me to?
No, definitely you should. But for I thought the way I would pose the question as we get into the topic of recession is define a recession. What is it? Because few people define it as negative growth for 2 quarters, but obviously in our macroeconomics, we did learn that that's not the right definition. So just to level set everyone as to what a recession is, if you could help us understand what that is and then get into your hypothesis, and it will also be good to understand why we are talking about recession in days like this, because everything, not everything, at least the stock markets are looking fine, but it's still relevant to be talking about it because the stock market does not necessarily
Right.
reflect the economy or how a common man is feeling about economy, right? So please
That's
go
the
ahead
first.
and
Well,
please go ahead and answer answer these questions. Yeah, please.
I was going to talk about a couple things. I actually don't remember the class definition of recession,
Yeah.
but
That's okay.
Was
Yeah,
the
I think it has
it's the period it was defined as the period between like the peak and the trough
uh-huh.
of the economic growth cycle.
Yeah.
right. So we talk about first of all, I'll just say the stock market isn't a great indicator of the recession. Stock market does a lot of stock market things that are fantastic, but not really an indicator of the economy as a whole. Um, we have a few recession indicators. I think that personally the big for me, is it a recession or not, is always going to be unemployment.
Hmm.
Um, Unemployment goes up uh, more and more, you got big problems. Unemployment comes from a lot of places, and that's what I was going to talk about. So there are a few places that can cause unemployment. One of them is actually like the Fed raising rates and kind of belt tightening. So the Fed raising rates is also going to do this thing called inverting the yield curve, which people may or may not have heard of. It's when the curve looks like this, meaning 30 years out, rates are lower than 10 years out. Sorry, yeah, or than 1 year out, I should say over here. So that can that can happen when rates get very low in the long term because people aren't so sure about the future. It can also happen when you've got events like COVID where rates are very low for a while and then the Fed starts to raise rates. And that raising of the rates can be an issue because people can't refinance anymore because when they try to refinance, the rates are higher, so they're not really able to help, not really able to do that. So that is a big issue that we have to be careful of. And that's why when the yield curve inverts like that, That's actually not the problem. It's when it starts to go the other way. It's when the rates go up in the long term and people can't refinance their debt anymore. There are a few kinds of classic recessions. There's, oil shock recessions like in the 70s. There's a dot-com bubble recession. Those are not as bad as the 2008 recession. That was a major recession. The really bad ones are always caused by bad debt. So bad debt that can't be refinanced, that people are underwater, and they just can't pay that debt. And then all those debts have to come off the balance sheets and basically get written off to zero. And that's when you see really bad issues. So that said, with all of that said, I don't think we're in that zone, the bad debt zone. I don't see a lot of bad debt. At least I don't see it too much. In the corporate world, a lot of the bigger companies, like the tech companies, are very healthy financially. I don't see um, the same kind of thing coming, but that is the thing to look out for. Like I said, we had it with mortgages. When rates go up, people can't refinance, and
Yep.
then all those things come off the balance sheet, and then layoffs happen, and then unemployment goes up. So for me, I would say unemployment is by the time unemployment starts to go up, we're probably already in it. But that is kind of the precursor to watch out for is bad debt and unemployment.
So unemployment, if I'm looking at the numbers correctly, is sitting at 4.4 percent. From what I remember, our professor mentioned that the unemployment target that the the Fed looks for is around 4%, right? And the inflation target is 2%. Correct me
Yes,
if I'm wrong in this.
that's
But
right. That's what
yeah,
I remember.
yeah, given given where we are at, and since you're talking about recession, what just remind me, are you predicting a recession anytime soon? Because it's not crazy high, like it's still in that, like I know it's 0.4% above. Uh, are you seeing anything in the yield curve recently that has changed uh that everyone should be what trend lines are you looking at as as
So
as you
right.
Yep.
So what I'm saying is that when we come out of the inverted yield curve, which is where we're at now, like we came out of it at the end of last year,
Mm-hmm.
that's the most dangerous time because people can't refinance.
Hmm.
And unemployment is the number I'm watching to be like, is this is this going up unpredictably? Like, is this going up more than I think it is? Because that's what has the cyclical recessionary effect. If people get unemployed, then they stop spending, which
Okay.
causes further unemployment. And so anything can kind of cause that unemployment. There's certainly a lot of speculation about AI causing unemployment. We
Uh-huh.
have yet to see that, but that's the number that I really watch carefully.
Yeah.
Um, and yeah, if unemployment numbers go up, you probably will see a drop in the stock market just because people get scared. Not because necessarily those businesses aren't doing well, but people are just
Okay.
afraid.
So
Yeah.
let's double click on that a little bit in terms of AI job displacement. Are we seeing any trends? Because so far I don't hear any major breakthroughs that the companies are saying, oh, we were able to use AI to replace X number of jobs. Of course, it happened a little bit in software engineering industry,
Yeah,
but
I think that's where we're
nothing.
seeing it the most.
Yeah, but nothing in terms of blue collar workers, right? So so are we do you think in the rest of this year or early next year we could see that happening, or we are a long way away from getting there, or
Well, it's, you know, there's a lot of jobs certainly, but there's what my friend calls the trifecta of jobs, which is healthcare, tech, and finance.
Mhm.
And those jobs are just the good jobs these days. Um, they pay a lot of money. the top like I think it's like uh I think it's like 10% of earners fuel like 50% of spending. It's something like it's crazy. It's a lot. And the economy is basically um, driven by this kind of consumer spending.
Yeah.
So, you know, one of those three legs goes tech, you could see major changes, um, I think. But it remains to be seen whether or not tech will simply absorb, tech will simply become more productive, or there will literally just not be more work to do. I think that remains to be seen.
What are the low-hanging fruits in terms of the what are the targets of tech industry uh, in terms of job displacement? Are we thinking that this AI could cause disruption in Uber driver, for example, or
Well,
gig
not
economy jobs,
it
or
would be program software engineers. Software engineers are the ones that are. I mean, I'm a software engineer, and I think there's a lot of speculation about what the future of software engineering will be like. Whether junior software engineers will have a place, whether they'll have to stay in school longer or cut their teeth on something on their own, because the value of a junior engineer used to be you weren't really valuable at all for
Mhm.
like a year maybe, but you would train that person up and you would give them kind of simple tasks to do to try to train them up. But now with the new AI tools, you know, you can basically replace that person. I don't know when they become useful now. maybe after like 4 years they would be useful now. So it's like a bigger gap for them, for new software engineers, I would say.
So
Yeah.
I always wonder, should I be more worried about job displacement that happens in the white collar workers or blue collar workers, or a combination of both? Because the way I look at a white collar worker job is they have the basic skills anyways. They could upskill and find a better job somewhere else. It's the blue collar jobs that I get most worried about, and for some reason I think that they'll have more impact on the economy than a regular software engineer, let's
Well,
say, job. So maybe I'm wrong. Correct me if I'm wrong on
I
this. But am
I
I?
think the old mindset was that a blue collar job that's eliminated, uh, that person has to retrain, and maybe they can't. They didn't go to college or something, so they can't retrain. I think that was the old kind of logic.
Mhm,
And Obama and people wanted to put retraining programs in and kind of modernize skills. This idea that maybe we don't need coal, we can do another job that's better, right? But the thing with AI is that AI is taking white collar jobs, and I think a lot of white collar people used to think, oh, those blue collar people should retrain. But but the new world is that no job is safe, or so, I shouldn't say no job, but many jobs which were thought to be safe, which were run on human capital, human brain capital, uh, are going to be mechanized. They're going to be replaced with automation. And that's just not something we realized was going to happen 3 years ago. It just wasn't on anyone's radar. And there's a huge push to do it. I think that a lot of jobs are safe. A
mhm.
lot of, I think a lot of white collar jobs are safe. That's why healthcare, I think, is safe. I don't think that, I don't think that the AI is going to make healthcare more productive, more efficient, but it's not going to replace those workers. Those people are going to have jobs. I think tech is definitely a place where you could see major disruption.
Got it. And Eric, I think couple of episodes back, you did mention where college undergrad students who are majoring in computer science are now looking at skilled trade jobs. Can you get our viewers up to speed on some of that activity that is being actively pursued by Gen Z? I think that's a very interesting thought process on how they are thinking about future job displacement. Yeah, I'll let you. Talk.
Yeah. I'll run through a quick refresher for those that don't remember, but there was also disclaimer, it's hard to tell how much of these articles are, apply to the whole United States, but it was a Wall Street Journal article that interviewed for, Gen Z, younger millennials. It was um, someone that had dropped out of university that was a computer science major to go pursue electrical engineering because they felt because the new advancements in AI was essentially going to make a computer science degree obsolete. So they threw their hands up and said, "I'm going to go to a skilled trade where I can, directly start making a good salary from day one and have kind of what you would consider like a recession resilient income stream. Everybody needs electrical work and homework and things like that. And then the next person they interviewed was I believe it was like either an insurance adjuster or someone that worked at a large insurance firm that and this goes in line with what I've seen from some large insurance firms, but they had been experiencing displacement on the job from new AI tools, and they went and started to train to become a firefighter, I believe. And then there was the next two people that they interviewed were actually university students that dropped out of school because they had the premise of, we don't want to rely on AI to tell us what to do or to, tell us where we're going to go in our careers. We want to start a company that will, use these AI tools to kind of generate a business. So I think they either made some consulting firm or some like agentic AI startup. I believe they're in Y Combinator. And then lastly, they interviewed a young woman who had started like it was either like a smoothie shop or an acai bowl shop a few years ago, and that has proven to kind of worked out pretty well for her because, again, something that's a little bit recession resilient. Of course, you're exposed to commodity costs there, and if you have a good product or not. But what we've been seeing out there in a lot of these news reports is there's a lot of people in industry right now that are kind of trying to pivot to find a more stable income stream, and then also there's a lot of students in computer science and computer engineering that are having to make a tough choice whether they want to continue down this path that may we in the US we talked about how liberal arts degrees may not have the most ROI compared to the student loans and all these things, and that's starting to that 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 narrative is starting to flow over now into computer science, which is kind of weird to see. It's a little bit different industry there, but you've ultimately seen a lot of job displacement and what I would call like disgruntled students and disgruntled like early career computer science folks, especially with a lot of the layoffs that have come through. Um,
It used to
but
be to maybe 5 years ago, not that long ago. Hiring was so great that we had boot camps for software engineers. You could learn in 6 months how to be a software engineer. Some of them were longer, but I mean, it was quick. It's a lot like learning a trade, like electrician, honestly. But the problem is that I think that those jobs aren't going to be around. Well, for one, boot camps got kind of saturated versus the job market. But the other big one is that the simpler things are what AI tools excel at coding. And to kind of come up now, I feel like you've got to learn it almost without AI because the AI will do it wrong. So the simplest things you can fully automate, and then anything that's above that, it'll do wrong. And you have to just know how to guide it or do it yourself. Sometimes I have to do it myself. I'm just like, okay, you're not getting what I'm telling you.
Oh, wait, Dave. It's hard to comprehend what you just said there. All I keep hearing is the models are getting better and better at
Yes.
predicting the variabilities, and there is a lot of reports that Claude is getting better, or there is another version of Gemini that is much better than Claude, and then there is ChatGPT, and then there is Claude getting even better.
Yeah, yeah.
So
So
I'm just trying to understand where you're coming from in terms of
sure.
this model is unable to take some complexity or variability in terms of giving the right answer. So,
Yeah. So I'll say a few things. One is that what does better mean? Uh, I think one of the reasons why Anthropic has leapfrogged uh, OpenAI is because OpenAI was trying to make their model better in a very generalized sense. And I think Claude and Anthropic, they made a general model, but then they really focused hard on productivity tools. Kind of like, Microsoft making Excel and Word. Like that's what are people going to use this for? And they succeeded very well in the uh, programming software engineering arena. I mean, it's just undeniable how much better it is than OpenAI, ChatGPT to me. Um, so with that said, it can do a lot of things. It can do a lot of things well, but it doesn't have all the answers, and it suffers from various, I will say, various problems. One of them is that it can only make you as good as you are in a way. Like, um, the thing I'll maybe I'll try I'm trying to shorten my explanation here a little bit. It looks for easy solutions. So if you
mhm,
give it a question, it will try to give you what you want in the easiest way. But as a human, we have a lot of context beyond that. We have a lot of context uh, beyond what's in the code. So just as like a quick example, that I think is that, everything we do in code tends to have some kind of metaphor or abstraction that helps us remember it, helps us understand it. Like when you open a folder in your computer, it's not really a folder, it's like a magnetized place on your disk. I don't want to get too in the weeds here, but
mhm,
we think about it like a folder. It helps us, you
mhm.
know?
Yeah.
And so we carry all of that with us when we code, when we make products, anything. We carry all of that context of the abstraction. The computer, it can kind of do it, but it doesn't know in the same way how to connect those things. It doesn't know how to connect the code with the product. It just doesn't, it can't do it. So there's a lot of things where you have to guide it. It'll also just use the wrong tool or strategy sometimes. And, it's just something that I know from experience. But again, that's something that a junior person isn't expected to know. They're expected to go and make a login page or I would tell a junior person, make this page and make it exactly like I made this other page,
Yeah.
and you'll be fine.
Yeah.
But the AI excels at that. That's what the AI does best, is make something like I've already made it or so
That
yeah.
that's an interesting viewpoint, given everything that I'm hearing about how these models are getting better. Eric, just curious. I know we talked a lot about AI and its disruption in software engineering, in the workflow and the jobs itself. How is that being applied in financial markets, in general? Maybe in terms of forecasting or in terms of predicting the stocks. I'm hearing a lot about having some of these chatbots make the trading decisions for you, and the chatbot will ultimately ask the user if it has to go and purchase this stock. I think it is very interesting to learn some of the applications. How much of that is feasible, applicable, And is there any increase in collective intelligence in terms of some of the AI capabilities that now everyone has their hands on, right? So just help us get up to speed on this very interesting application of AI in financial markets.
Yeah, I've definitely been following a little bit of this online. There's there's a few Twitter accounts that have built um like AI powered portfolios. There's one, for example, that has, all the different Claude models, all the different OpenAI models, Grok, DeepSeek. It has them building actively stock picking and kind of adjusting its portfolio, and it has a leaderboard of who has the highest return year to date and all this, and then there's some other one-offs that just have a Claude portfolio or a Grok portfolio where I'm not exactly sure how they prompt it to do the stock picking. I was having this conversation with someone the other week where they said the output's only as good as the input because everybody has access to the same tools. And the thing about financial markets is, it depends what investment thesis you want to take. If you want to take a bottom up approach where you're analyzing if a stock is undervalued or overvalued compared to where the market has it priced, or if you want to trade based on technical analysis or news flow or options flow. Those are all things that have to be taken into consideration when you're making investment decisions. And I think these tools are really powerful, but at the same time, I don't know if they'll eliminate, you know, I guess to even take it one step back, if everybody had the exact same the exact same valuation on every single company, there wouldn't be a stock market. It would just trade flat every day. There wouldn't be movements day to day. So I think you might see efficiencies within larger equity trading firms, probably like hedge funds and quant firms where they can really refine their proprietary models. Those are often things that they keep behind closed doors and they don't really talk about with other people because, the whole game is to generate alpha. And if you, for those that don't remember, alpha is essentially like the excess return for a unit of risk, within the market. So if you're able to earn, 1% more than the S&P, that's generally how people describe alpha. But I think the academic way is you still have to account for risk
Wait,
factor there.
wait, if
Yeah.
alpha is so important, Dave, how come we are not, no professor is talking to us about it? Wait, no, I'm interested. Maybe it's a conversation for another time, but I would like to deep dive and understand what this alpha is. I'll let you continue. Sorry.
Yeah, yeah. I mean, just to even touch on it a little bit, that alpha is a pretty general term that people use to describe excess return over whatever benchmark. So if you're benchmarking against the S&P and the S&P earned 12% last year and you earned 15%, most people will describe that as you got 3% alpha generation, but really that's just 3% excess return.
Mm,
True alpha takes into account um, your units of risk. So it's like a risk adjusted excess return. So you'll often kind of hear alpha used in place of excess return, but that's what these models could potentially be used for. I've seen, online a lot of these, Reddit users and Twitter accounts where they're generating these active portfolios based on the models. I don't know if they're actually trading in real time or if they're just paper trading, meaning, for fun and tracking the performance. But yeah, these are definitely tools that will, at the very least, be able to allow you to perform fundamental analysis and news flow analysis on a much quicker basis. When a 10K comes out or a 10Q, the quarterly or annual financial report comes out, these tools can definitely help you parse through it and see if there's any trends that you might be missing and populate your Excel model within a couple minutes at most versus maybe it takes you a little bit longer. And so there is yeah, definitely speed to be had and benefits to be had, but I think it also depends on the end user in this case.
So in terms of the risk that Dave was pointing out in the software industry, that this model may not be right in financial markets, the repercussions I think would be much higher, right? So, what are your thoughts on the risk that, what is your advice on people using these models, so that they don't, uh, yeah, they don't commit, they don't trust it blindly, right? So how much is that risk, and any thoughts that you could share on that front?
Yeah, I mean, there's big risks there. I think within financial services, you've seen a lot of the larger players embrace these AI tools. So I've read JP Morgan has a wide range of internal AI tools that they're using, not only for like for analyst type work, but also to help their managing directors prepare for client meetings. So I definitely think there is productivity to be had, especially on the kind of the legwork side of things. But um, as someone that's not, the biggest expert in this, there still is a lot that I'm sure relies on prompting and how you kind of, give it the right context and make sure it's fact checking itself. But again, these are tools that love data, and financial markets are essentially, data, and it'll be interesting to see how this plays out next 12 months. But yeah, definitely the larger players have been embracing it a lot sooner than
I mean, even before I think LLMs, uh, you know, as deep learning was kind of coming up, there were a lot of large institutions were building their own deep learning models based on historical data.
yeah.
Again, specialized to predict. It works somewhat, but not as well as you would think.
Yeah, I mean, even not to have a cliffhanger, but to take it one step further, I've read about HSBC is a global bank. They have a quantum computer. So, we're talking about LLMs, and there are institutions out there that have quantum computers and are developing tools based around that. So, it's always interesting to think about what's not two steps ahead, but maybe 5, 10, 15 steps out there that companies are working on.
Yeah. Got it. I think what I'm understanding based on of what I'm hearing is, do not trust AI blindly. Make sure that you do the due diligence, and use your own knowledge to check if the deliverable is correct before you take any
You
real
know,
time actions.
and
Right?
that's always the thing that I'm wondering about AI as we enter this new era is like how many people are trusting it blindly, and is that going to lead us into disaster? Or
Mhm.
and how many people are using it as a tool to research and grow themselves,
Yeah.
right? Like that I think will really kind of determine our path as a
Yeah.
society.
Yeah. Yeah. That's
Whether
right.
we lean on it and become like idiocracy or we, use it and it's like a calculator that we just makes us stronger.
Yeah. Yeah. Just curious. Are you AI optimist or pessimist, Dave?
I don't know. I'm a open-minded ist. ist.
Okay.
Um, I don't really know. It's hard to predict a new technology, what's going to happen.
So
I guess
you're
overall I'm an optimist.
that's good to
Um,
know. Eric,
yeah.
you?
I still think it's early innings. To I guess to use a baseball term there, I think that there's a lot of money being thrown at this to kind of advance the newest and brightest models. But and again, we were talking about Anthropic and OpenAI's valuation a couple weeks ago, and we've seen Anthropic reportedly has overtaken OpenAI in the
Yeah.
private markets
Yeah.
for
Yeah.
valuation. But I again, there's a lot going on kind of under the waves with the economy, and it's I think things will have to play out for us to really see if this is ultimately a productivity driver or just becomes like another Excel that we don't really even think twice of.
Yeah.
Well,
Yeah.
Excel was definitely a productivity driver, though.
That's right.
Yeah.
Yeah.
Now
Yeah.
we all have our own views on Excel.
Yeah.
I think the question will be whether or not if in 2 years we see a large displacement of jobs where it was all panic and we see a
Yeah.
large increase in productivity.
Yeah. Yeah. That'll be interesting to watch. All right. So with that, I think we can end this podcast. One thing I wanted to emphasis is by no means we are saying we are trying to discount what is going on in Middle East. Even though the stock markets rebound here, we still hope that there will be settlements and there will be more peace, so that there is more prosperity collectively as humanity. So, all right, with that, we'll end this podcast. Thanks everyone for joining. Yep, see you. All right, stop the recording.